It bears note that going into the global financial crisis in 2008, the CPI was around 5% year on year. I think it's 6 months later, it was minus 2%. I mean, the speed with which we can go from inflation hysteria to, feeling like we're Thelma and Louise staring over that cliff, of the deflation precipice will be incredibly fast. And I think it's going to catch a lot of people by surprise.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Inflation remains the center stage villain in the economy right now, with the latest consumer price index coming in at a 41-year high of 8.6%. But is there a bigger bad lurking behind the scenes? Could deflation be the real threat here, just waiting to pounce after today's hot inflation has burned itself out? To explore this, I'm thrilled to welcome Stephany Pomboy back to the program. Stephany's been concerned about the deflation spectre for quite a while. She's also recently done a tremendous job guest hosting this program, and I thought it high time to turn the camera back on her for a dedicated interview. Stephany, thanks so much for joining us today.
Thanks for having me. Always so much fun to get to catch up with you, Adam.
Well, same here, Stephany. I got a lot of questions to ask you here, but let's just start with my normal high-level one for you, which is, what is your current assessment of today's global economy and financial markets?
Okay. Well, my view for quite some time, coming into 2022, has been that the Fed and Wall Street were grossly underestimating the role that stimulus played in driving the recovery, both in the economy and in financial assets. And that therefore, they were underestimating the impact of its withdrawal. And I'm talking about both the monetary and fiscal stimulus. And if you just look at the numbers, I'm a geek, so that's what I like to do. I like to start in the data. You see that we got precious little bang for the stimulus buck during the 2-year recovery. We had roughly 10 trillion in combined monetary and fiscal stimulus, for which we got 2.3 trillion in nominal growth, an increase in activity of 2.3 trillion. So that's not exactly what you would call productive stimulus.
No, we didn't even get t-shirts either.
Exactly. And then worse than that, most of that growth, quote unquote, was vapor. It was inflation, the topic of the day. So of that 2.3 trillion, 1.7 trillion was higher prices. So in terms of real activity for our $10 trillion in stimulus, we got 600 billion. And for that, the stock market went up 15 trillion. So, I'm sitting here watching this saying, there's a gross mismatch between perceptions about the underlying strength of the economy and the reality. And obviously, we can go through all the details, but this has really been my overarching thesis, is that people haven't looked at those numbers. They don't appreciate the degree to which the consumer and the markets were totally dependent on all of this stimulus. And obviously, both on the monetary and fiscal side, we come into 2022 and they're falling away. In fact, on the Federal Reserve side, we're actually going to see a reduction in theory in the balance sheet. So that will be a net tightening of conditions. So that's been my framework. And obviously, I've been very concerned about what it means for growth in the economy, what it means for earnings, where expectations have been very unrealistic, I think, and then by extension, what I think it means for the financial markets as we go through the year.
Okay, all right. So we had this, massive force feeding of liquidity into the system. Turns out most of that force feeding was sugar. So we had this massive sugar high, which everybody thought was, brand new energy that was going to power us to the moon from here. But like any sugar rush, it wears off quickly and there's no real nutritive value to it. And so now we're at that point where the sugar rush is wearing off. We're realizing we didn't get much for it. And actually now the meal tray is getting pulled away now. So we kind of almost have this double whammy coming here. I hope I didn't murder that analogy too much.
No, actually, you summed it up much better than I did. And I guess, the other problem with this is that we are dealing with this new beast, and that is the higher prices, the inflation, especially in food and energy and all the things people can't live without. So at the same time, you're taking the stimulus away, you're actually imposing even further tightening or tax on the consumer and businesses in the form of these higher energy prices. So anyway, I'm sorry, I cut you off in your.
No, 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 no. That's great, and that's a great segue. So let's talk about the news of the day, which is inflation. So we just got the new consumer price index numbers. They came in at 8.6%. So the people who were saying that they thought this reported CPI had peaked back in April, apparently not right, weren't right on that. And I was one of those people. So I'm willing to say, hey, it didn't work out as I thought. That said, 8.6 is not that much higher than 8.5. But I'm going to ask you about disinflation just a little bit. So let's put a little bookmark in that. But right now, inflation is at a 41-year high. It's really high. It's painful. People are seeing it when they go buy food at the grocery store, when they fill up their cars. Not trying to diminish the pain here at all. So my question is with now inflation back on the rise, is this something that may force the Fed to accelerate its tightening and rate hike? It's already announced tightening and rate hike plans.
Yeah. Well, the other number that was reported just an hour and a half after that gangbuster CPI report was consumer sentiment, and that hit a record low. And I don't think that those two numbers are unrelated. And I think that that really kind of gets to what I think is the key headwind to broader inflation. And, I hate to, I'm not going to suggest that you need to separate out food and energy, because obviously that's the stuff that we must have to live on. However, I think that that's where the inflation is going to be confined going forward, and that what you're going to see is a crowding out of inflation pressures by those very important food and energy prices. Because as you see in that consumer sentiment number, people are just so beaten up about what's happening with prices, and they're being forced to make really tough choices. We have seen since last April, this kind of coincides with when the last stimulus check went out. When Biden took over, he and his new Congress haggled to get a final or a first stimulus bill put together. And by March, checks started going out to households across the country. That was the last batch of COVID stimulus checks. By the end of March of last year, essentially, we had stopped getting any more stimulus. So when you start April 1 of 2021, you can start to look at what the impact on the consumer was of the end of this stimulus. It also happens to coincide with when the CPI really started to ramp higher. It basically went from, I think, 2.5 at the time up to 8.5 where it is today. So in that 1 year span of time, we have a pretty good window as to what the impact of the simultaneous withdrawal of stimulus and increase in prices was on the consumer. And what you find is that discretionary spending really got hit, or not get hit, but really slowed down dramatically. And consumers were forced to dip into savings and run up credit card debt just to sustain their consumption of the basic things that they needed in life. You've seen credit cards, they were paying down credit card balances going into April, and then they did a complete U-turn, and now they're borrowing. We've seen back-to-back record increases in credit card borrowing in the last several months. At the same time, they dipped into saving to the tune of $1.5 trillion over that stretch of time. Together, that is what funded 1.6 trillion in consumer spending growth over that stretch. You literally had a 1.6 trillion increase from April till April of this year, 120 billion increase in credit card debt, and a 1.5 trillion dollar drawdown of savings. So the math works. So basically, I guess my point is that consumers are clearly being forced to resort to sort of desperate measures to keep up with their current cost of living. And as those food and energy prices continue to go up, they're going to have to make even more tough decisions. So I think what's going to happen is that in 2021, the story was all about lack of supply. You know, all the supply chain dysfunction was such that you weren't having goods on the shelves. We have flipped to 2022, and all of a sudden, inventories are a problem because we've destroyed demand. So we went from a supply problem to a demand problem. And so when it comes to talking about broad inflation pressures, finally getting to the answer to your question here, Adam, I think that those headline numbers are going to remain sort of elevated to the extent that it takes a while to offset, you know, those higher food and energy prices by the destruction in prices everywhere else. But what really I think is critical is that as we go through the year, the inability of companies to pass on higher input costs unilaterally, which they've been able to do with the tailwind of the stimulus for a long time, is going to really hit margins. And that's going to be the big story this year. It's starting to become a topic, but it's still not priced into the market. It's still not in the consensus expectation for earnings. And the reason that matters so much is not just what it means for the stock market, but the number one input into hiring, the number one decision for hiring is profit growth. So if we see profit growth go down, and I'm not talking about the level of profits, it's the rate of change. So even if profit growth goes from, you know, 50 to 10, that's going to be enough to cause a really dramatic slowdown in employment growth. And that, again, will feed into this consumer problem of not having the money with which to, you know, sustain increased spending across the board on higher priced goods.
Okay, so you have just brought up like 12 things that I want to dig into here. But you're taking this discussion exactly where I want to take it, which is the big question that I want to try to answer in this discussion with you is, even though we're all freaked out about inflation right now, is the bigger risk that we're heading more into recession, ultimately slumping prices, especially for assets, and you know, reduced economic growth, maybe economic shrinkage, layoffs, all that stuff. So while the attention is focused on, you know, the immediate acute pain of the hot inflation, should we be devoting a good chunk of our neural focus to what may come after, right? Which is the economic, you know, stagflation, malaise, recession, and all the really even more unfun stuff that comes along with that. Before I get totally into that arc with you, though, a couple things you mentioned. One, you mentioned the recent University of Michigan consumer sentiment numbers, which I think came in at like, it was like 50.2, I think, and that is the lowest in the series that I saw, which went back to the 1980s. And I look, I get why consumers aren't confident right now, but I am shocked. I'm like, wow. I mean, you're comparing that to when we shut the global economy down during a pandemic 2 years ago. You're comparing that to the Great Recession. You're comparing that to the dot-com bust. I am amazed that it is that bad this quickly. Not that I don't think there are reasons to not be confident, but it just, on a relative basis, it really shocks me looking back on those eras. It certainly flies in the face when Jerome Powell gets up and says, hey, the data says the economy is very strong, folks. You know, what's your take on why sentiment is this bad?
Well, I think it speaks to the degree to which most of America never really enjoyed a recovery. And I'm talking about not just in the last 2 years during COVID, but going all the way back since the global financial crisis. I mean, we've been widening that wedge between the high end and the low end
Right.
for much more than a decade now, as you have talked about a lot on this program. So I think that it speaks to that, that for the average person, you know, what was going on in Wall Street was just like some completely other
Like it was going to
universe.
Mars. Yeah.
Yeah, exactly. And it really has been. And that's why I've been so bearish on stocks for so long, because I just saw this widening of this wedge between the economy and financial assets. And obviously, you need only look at that classic Buffett indicator to see just how we have been expanding that wedge since the global financial crisis. So I think that's what it speaks to. I do get pushback because I really point to that Michigan survey a lot, and I overlay it with things like actual consumer spending, and the S&P, and you see a tremendous fit, not surprisingly, between consumer spending and how they feel, and the stock market ultimately ends up catching up to consumer sentiment. But the pushback I get is, yeah, but look at the conference board measure, because it's come down a little, but it's nowhere near where the University of Michigan survey is. So why look at the Michigan survey? If you go back and look historically at those two measures, the only time when they really dramatically part company is always with the conference boards maintaining strength as University of Michigan goes down, and it's always a signal of impending recession. It's almost without fail that you've seen when they part company and UMich is going down, you want to buckle up because recession's around the corner, and the conference board ultimately ends up coming down to meet it.
All right. Well, yeah, this is so important because you did a phenomenal interview with Peter Atwater last week. And folks, if you haven't watched that, you really should go see it. I'll put up a link to it right here. But Peter, he was an economist. He was a hedge funder. Now he's a professor, teaching about economics. But he specializes in a certain area called socioeconomics. And his real special is focusing in on confidence, because the way people think determines how they're going to act, right? So that's why confidence is so important here. And I think you did make a really good point there, Stephany, which is that, I think a lot of people who, what is it? 89% of financial assets are owned by the top 10% of households or whatnot. So with the massive recovery that we had in the stock market, in the bond market, since the depths of 2020, didn't really make a difference to the vast majority of people in America. What did make a difference was that they were, getting checks in the mail and they were getting some relief from what was going on. But as you said, that's now ended, right? So in some ways, I guess I guess the point you're making is that Americans are they're kind of losing the script here. They're losing faith in what they've been told and what they've seen, and without that artificial support, they're revealing their true pessimism about the system. Is that pretty accurate?
Yeah, I think so. I mean, I think it just speaks to the way you summarized it, which is that it was a sugar high. And, for most people, they enjoyed the sugar for the brief time they got it, but now it's back to reality. And reality it's actually kind of a new reality, because most of us never had to deal with inflation like this. It's the highest level of inflation in 40 years. So that predates, the vast majority of consumers out there.
Right. To murder the analogy, the sugar rush is off, and they're now getting told by their doctor they've got diabetes. Right. Wow. By the end of this video, folks, I am really going to have just slaughtered that thing. All right. Well, look. So these higher prices are cratering consumer confidence. They are highly likely, and correct me if you disagree with me, they're going to be, cratering the confidence in corporate America too. You talked about how, a lot of what you sort of said in your initial answer was really, high prices are going to be the solution to high prices, right? Where you're going to get organic demand destruction just because energy and these other input costs get so high that people are going to spend less. I want to talk in a moment about the Fed, because the Fed is actually, lending a lot of additional weight to demand destruction here. So you've really got organic and, whatever you want to call what the Fed is, another external but highly influential actor in play here. But you kind of gave a nod to the fact that forward earning estimates still are pretty rosy, right? They're still projected to be, material growth from 2022. I don't know what they're smoking to be able to say that with confidence. And that's going to be an early indicator, is when you start seeing those earnings estimates come down. Do you think that's something we're going to be seeing pretty soon?
Well, it's amazing. So I've been on this story. I mean, people who've been reading my work probably are so tired of hearing about it because I've been tracking this CPI versus the PPI, which I is my profit proxy. It's basically measuring input cost to businesses versus their ability to pass them on to consumers, the CPI. And in the last year, we've seen a gap between the two of those that implies the most acute margin squeeze since the 1970s. So it's not only forecasting a profit recession, it's forecasting the worst profit recession in 50 years. And not only, as you mentioned, is that not on the Wall Street strategist radar, but they still are forecasting growth and double-digit growth in S&P earnings this year. Now, admittedly, that number's come down from the beginning of the year, but it's still positive. So they're forecasting 10% growth for S&P earnings for the rest of this year. Ex energy, they're at 5%. When the year started and before energy prices really went completely bonkers, I think they were at like 9% for S&P earnings, which and it was about the same for the X energy. So they've taken down the X energy component, but still at 5%. And the number that just is staggering to me is that consumer discretionary, which is, I think, the point of maximum pain here. They forecast earnings to be up 24% this year after being up, I think it was 47% last year. And then I went and looked at, this is as of today. I just got an update. Bloomberg does this summary every Friday. So that's fresh off the, fresh out of the oven numbers. What are they looking for 23? 38% growth. So we're going to go from 48% growth in consumer discretionary last year to 24% growth in earnings to 38%. So, I mean, it's to call it pie in the sky is, to demean it enormously. So I think we've got
that. I mean, delusional sounds like a better number here.
Down 24 would be right.
Yeah.
So the amazing thing is, we haven't really seen those numbers come down. We had Amazon, Target, Walmart. I mean, all the big high profile companies come out and disappoint and warn and complain about inventory issues, which suggests we're going to see more weaker earnings numbers because they got to unload all that inventory. And yet analysts still are stubbornly holding on to these forecasts that growth will, these earnings will rebound. So I think when I look at what's going on in the stock market, I think we're just starting to see the stock market anticipate the reduction in these earnings numbers. But the process of going from plus 24% growth for consumer discretionary to plus 10 to 0 to minus 10 or whatever your number is going to involve substantially more pain on the stock price.
Right. And we're going to get into this in a little bit, but exactly that, right? So I'll even switch to next year, which is plus 38%, going to plus 16, going to 0, going to negative. That highly indicates that the pain we've seen to date in the stock market is not over because they haven't brought down those expectations yet. And when they do, mathematically, share prices are going to have to come down because theoretically, share prices are a function of expected forward earnings, right?
Right. Yep. Absolutely. No, I mean, and even if we go back to that Buffett measure, I mean, we barely made a dent in the market overvaluation right now. So, I don't want to get too far back into the bear cave this early into the conversation, but let's just say there's plenty more downside to come to bring us back to, what is a historic mean fair valuation.
Okay. All right. Well, look, let's just close this off here. So in terms of the profit squeeze that you expect to see in corporate America, a term you use a lot that I just like because it's a great turn of phrase, but it really does sort of symbolize what we should be looking for is, you say pretty soon we're going to start seeing bodies float to the surface here, right? And I think you're making a case that, as corporate America's profits begin getting squeezed, some of the weaker players are going to start failing. And I imagine when you have the combined effect of squeezed profits and higher debt service costs. That 20% of corporate America that's a zombie company. I mean, those guys are going to go first, right? But then there are also funds out there, right? There's big funds that have been using lots of leverage. You always, kind of see that quote, who's been, swimming naked when asset prices get whacked, and you discover a couple of funds. There was Archegos, whenever that was, a year or so ago. So my question to you is how soon do you think we're going to start seeing the corporate and institutional bodies start floating to the surface here? Because the markets are down a fair amount this year, and as of Friday, they're going down substantially further. So
Yeah, well, and you have started to see it more on the institutional side, like you're talking about Tiger Global. So
that's
there
right.
have been some, the hedge funds that have been really levered. On the corporate side, this is where I've really been focused, because it's very hard to know what funds out there are positioned in what, and how exposed they are or vulnerable to actually having liquidity issues. On the corporate side, when you look at the S&P 500 companies, it's a little easier to quantify. Like you said, you've got 20% of those Wilshire 3000 companies are zombies, which means they can't even service their existing debt with current income, much less given what we're seeing in terms of the backup in interest rates. If they have to reset, roll their debt at those rates, they're really in trouble. But so I've been looking at that, and I've been waiting, kind of tapping my fingers to see the increase in defaults on the corporate side. I think one of the things that's kind of maybe disguised the problem and kept those bodies beneath the surface. God, is that a gross analogy? But is that a lot of them are loans. We had this surge in levered loans. And so, the parties know each other. And if your borrower isn't going to be able to service debt at whatever percent rate, you come in and you actively restructure that before it becomes a problem. So I think there's a lot of active renegotiation, restructuring going on in that space that might be, presenting the illusion that everything is okay when it really is. They're stressed already. It's just being, managed, let's say. But I would imagine we'll start to see an increase in corporate downgrades for sure. I would think that, the ratings companies will start to get on there and be downgrading these companies, especially as those earnings numbers come down. But it's something that honestly, I'll confess, I've been surprised that it hasn't been more of a problem yet, because I've been looking at the increase in corporate borrowing costs and just been blown away. And no one looks at this, I think, because they're looking at spreads. Everyone's been trained. You look at junk spreads or investment grade spreads, and looking at spreads, it doesn't look that remarkable. I mean, spreads have backed up some, but on a long-term chart, you can barely see that they're up at all. Because they've come, they reach such low levels.
Yeah.
But when you look at actual yield, so junk yields were 4% at the end of December. They're 7.5% today. So 350 basis point in 5 months.
Yeah, which is crazy. And sorry to interrupt here, but I remember remarking at how nuts that was. 4% is a ridiculously low rate for high yield debt. But I remember marking at the time, when inflation was running at 6% or whatever, saying that, and not only are they so low, but they're below the rate of inflation. What's crazy is they're a lot higher now, but they're still below the rate of inflation. It just shows what sort of a crazy, bizarre era we're living in right now.
Absolutely. No, I mean, that gap is closing.
It is closing.
But and the other thing I would layer on, since we're talking about inflation, is that if you look at the rate of increase in corporate bond yields, let's say you take investment grade yields year on year, and you add oil price increase on a year on year basis, anytime, first off, we've never been at this magnitude of a increase in both interest rates and oil prices at the same time. But anytime we've been close to this level, not surprisingly, you've either had a financial crisis or a recession. So, I mean, it makes me wonder why we haven't seen any signs of strain to this point. And the only thought I have is that, a lot of this stuff is kind of being managed somehow. Maybe some of these companies still have PPP money. I don't know, but
Yeah, well, so great points, and I think there is both on the consumer side and the corporate side a little bit. There still is a little pig that's left in the python, of all that stimulus. It hasn't all cleared out yet. Of course, there will be a time where it will all be completely through, and then I think things are going to get even worse. But I really like what you identified here because I've been talking about this a lot recently in both the jobs market and in the housing, where there's a progression that you normally go through before the end game. So, like in the jobs market, people start with a hiring freeze, right? They don't want to get straight to layoffs because it's expensive to have to rehire if they lay somebody off, right? So first you do a hiring freeze, then you start cutting hours, or you start reducing bonuses, or you let go all the contractors. But only after you've done all that do you then actually start really laying off people at scale. So you kind of get an early warning system before layoffs happen, at high volume. I think this is exactly what you're saying here. I'm just curious, is there any service that sort of monitors these debt restructurings, or do they all just sort of happen behind closed doors?
no, I think that, gosh, I remember seeing something on Bloomberg that talked about the share of distressed debt that was being sort of, I forget what the technical term for it is, but it was essentially renegotiated. But it was in an article. It's not like they had some, chart that showed you historically where we were or gave you any kind of signpost. And they do have a distressed debt index that they, each week update that you can see. But, we're still, I think, when you look at those kind of measures, they don't have a lot of history. And the history they have says it's the worst since during COVID, which doesn't really help you because you want to know, other than COVID,
Right, right.
where are we? Because that's, so sadly, I wish I could be more useful on that. But if
No,
there,
but I think it's very important to know that it goes on, and it makes a ton of sense. It's sort of like, in my mind, it's sort of like gangrene, right? If you're a lender, you want to try to help your lendee, the company you've given money to, you know, be able to still pay you back somewhat versus taking a total loss. But once the gangrene gets up to a certain level, you get to a point where you say, you know what, I got to chop this limb off, right? And I think that's we're probably in the process where we're watching them, see it creep up, but they haven't quite yet hit that limb chop. But why all this is important is because these things sort of tend to be like exponential in reverse, right? Where they move slowly, 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 and then everybody, decides at once, all right, or all the lenders, kind of around the same time just begin realizing, it's gangrene time. We got to start chopping off limbs, and that's when you see, the herd stop supporting, the status quo, and then you start seeing the cadavers, plop up here.
absolutely. I think people would probably really prefer the sugar analogies to our bodies beneath the surface and
I know, and gangrene. You're right.
oh my god.
All right. Well, let's move on here, and I'm sure we're going to come up with a couple of new analogies here.
One last point on that while we're talking about the corporate sector.
Please, yeah, please.
One thing I should mention is that there's this kind of belief that corporate balance sheets are in good shape, and it's not just a belief held by Wall Street, but Jerome Powell has repeatedly said that in his FOMC pressers. He's described household and corporate balance sheets as being strong. And the point I wanted to make on the corporate front as relates to this issue of debt service and ability to manage higher inflation and debt service costs is that of the S&P 500 companies, as it is with consumers, the top companies hold all the cash. The bottom companies have almost none. So in fact, the top 10 companies have more cash together than the bottom 400 companies in the S&P 500. And those are the largest 500 companies in the country. So as you go beneath that, you have to assume that pretty much there's nothing between, the average company out there.
Right. This is where the difference between mean and median actually makes a tremendous difference.
Yes, absolutely. Yeah. So, just like, the bottom 100 companies in the S&P 500. So the, let's say the, what would you call that? The fifth largest quintile of companies in the
Hmm.
entire country together have 20 billion in cash. 20 billion among 100 companies.
Wow.
So, and again, those are the strongest balance sheets one presumes. Anyway, I just wanted to make that point because this fantasy that the corporate sector balance sheets are in fine shape, again, is drawing a conclusion based on an average that doesn't reflect any company out there because there is no average company. There are the guys with the cash and there's the guys with the debt.
Right. All right. So, so just made a great point about the consumer, sorry, the corporate, the health of the corporate balance sheet is not necessarily as rosy as we're being told. I just put out a video a couple days ago that went through kind of a parade of data showing the same is true with just regular consumer households. If you want to get all the details of that, I'll put a link to that video up here. I won't go through that whole litany of data here, but if corporations are not doing nearly as well as we think, and consumer households are not doing as well as we think, and going forward, you expect the macro environment that you just mentioned, where economic growth is slowing, profitability worsens. That's going to basically lead to lower financial asset prices. It's probably going to lead to diminished job opportunities. And I'm trying to not just go to like, hey, we might have a recession with a bunch of layoffs, but that's a potential of what could happen here, right? So, we could see a future here where, you know, the way things felt in 2021 is going to feel like the good old days, and we could be in a recession that's as painful as the dot-com bust, great recession, or whatever. We could, and I guess my question for you is, as you look forward, do you think that sort of slump into recession is more likely than not? And if so, how bad on a relative basis do you think this recession is going to be versus kind of your garden mill recession?
Well, I definitely think we're gonna have a recession. I 1,000% think we're gonna have a profits recession. But I have a hard time imagining a scenario where we have a profits recession that we don't also have a recession in the economy. How bad that gets, I think, and I hate to say it, will depend largely on how the Fed responds to it. Because I do think, what we've kind of been hinting at in this whole conversation is this idea that the beast that they're trying to kill, this inflation beast, is already killing itself in everything except oil, let's say, and certain foodstuffs. And the only thing that's going to kill the inflation and energy would be a reversal in the domestic energy policy, I think, here, but that's a topic for, another day. But it doesn't look like that's going to happen. So I think, it becomes a question of, does the Fed realize how far down this road of demand destruction do they go, and how much earnings pressure and corporate credit distress do they abide before they say, oh, look, actually this inflation problem that we're trying to kill is taking care of itself. And if we continue to compound by raising rates, we might precipitate something like 2008 all over again. I think that's really what it's going to come down to. It's also going to be the determinant of how much pain we experienced in the financial markets, which also is a major factor in this inflation discussion. It bears note that going into the global financial crisis in 2008, the CPI was around 5% year on year. I think it's 6 months later, it was minus 2%. I mean, the speed with which we can go from inflation hysteria to, feeling like we're Thelma and Louise staring over that cliff, of the deflation precipice will be incredibly fast. And I think it's going to catch a lot of people by surprise if we do see a stock market meltdown of that magnitude. So that's a major, like if you overlay, for example, again, I announced myself as a nerd at the top of this conversation, but if you overlay household net worth, which is a really good window into asset inflation because it captures obviously both what's happening in real estate and what's happening in the stock market. If you overlay the change in household net worth with the change in the CPI, household net worth leads almost perfectly by 1 year. So as household net worth starts to slow down, it doesn't even have to go negative, just rolls over as it did in the latest quarter per the Fed's flow of funds report that came out yesterday at noon for all of those of you who are also watching that on their calendars. It suggests that we're going to start to see inflation pressures recede here at the CPI level.
Okay, so I wanted to shine a light on something you said because it's really a main reason why I brought you on today, where you said that the speed at which we can change from an inflation freakout to, oh my God, we're going into the abyss of deflation. History shows that can be pretty sharp, right? And in going into the 2008 crisis, you didn't have the Fed, to use your analogy, jamming its foot down on the accelerator of the Cadillac there, right? Which the Fed is doing right now. It's saying, I want demand destruction right now, right? So the Fed is actually trying to drive us away from inflation at this point in time, right? And you're right, the Fed's actions here will play a big role in how this unfolds. I guess the question I have for you is the Fed has it's hard to find really good examples of the Fed engineering the outcome it says it wants to engineer in the way it wants to engineer it, right? It tends to be very sloppy. I'll liken it to, driving a big tanker, right? You turn it to the right, and then at some point you want to go left, and you turn it to the left, but it takes a long time for that momentum to slow and then for the tanker to start going around the other direction, right? So it tends to create what people say, a lot of policy errors where it pursues an agenda and then it over creates the outcome it was looking for. And inflation is a great example of that. For years, the Fed was saying, we want more inflation, we're trying to get more inflation. And now it's like, oh my God, we've got way more inflation than we want. Now we got to bring that inflation down. So where I'm going to is how likely do you think it is that the Fed is going to thread the needle here and engineer a soft landing where if the inflation snake indeed is eating itself right now, the Fed is going to lighten up on its demand destruction to kind of glide us to a gentle, ending here? Or is it going to be pursuing demand destruction to the point where it suddenly sees, inflation's beginning to take care of itself, but it's got so much in the system, it's just going to drive us way further towards recession than it really ultimately would want to?
I mean, this is the $1 million question. And I guess I would say, given that car analogy, we're big on killing analogies to death.
Yeah,
here.
and sorry, since we're talking about inflation, I think we have to make it at least the $1 trillion question.
Oh my gosh, fair enough. I'll make it the $64 trillion question. But the reason why the Fed, I think, manages to get this wrong every time, and they, push on the accelerator when they should be on the brake, and vice versa, is that they, as a matter of practice, navigate by looking through the rear view mirror rather than out the windshield. So they're always looking at what happened yesterday and thinking, okay, well, that's, we got to tackle that. Meanwhile, the road ahead is already doing a million different things. So that's, I think, what gets us into this problem every time. But they also obviously have this institutional predisposition to be more accommodating to the markets than not. And that's obviously hit them pretty hard this time. But I think the likelihood that they thread the needle has, I think it's zero, because they've never managed to do it before. So I'm going to go with the odds on bet that they won't pull this one off. This is like a feat of daring do that, would be something for Houdini to pull off. And we're expecting Jerome Powell and his gang of, Magoo, myopic monetary people to figure this out. I mean, it really strains credulity to think they're actually going to be able to engineer a soft or even a softish landing. Um, so I just see them probably pushing too hard. I think the thing that was noteworthy to me was when the market touched that down 20% threshold, that milestone briefly, all of a sudden there was some, rhetoric out of the Fed. Well, maybe we won't have to go 75, or maybe we won't have to do 50 all the way through the end of the year, or
Caustic's pause. Maybe we'll pause in September. Yeah.
right. The more we do now, then we can stop and assess where we are. So it'll be interesting to see how that goes. It's very hard for me, as someone who's not a Washington insider, to really be able to get sort of handicap the odds of the Fed reversing or doing another Powell pivot, because he did meet with Biden the other day, and it seems like the administration is really aware now that inflation is their number one issue and they've got to tackle it. And the question is, was Biden's message to Powell, you better get on this, and we really want you to just be Volcker, or will they start to worry about what the impact is if, let's say, the market's down another 20% between now and November? This is all, I can't figure out what the likelihood is of the Fed actually, continuing to move forward, but they profess that they're going to be Volcker. So now that at a minimum, they have to go a couple more times, because otherwise they look like complete buffoons. And that may
Correct.
be enough. That may be enough,
Right. Not like they already haven't sort of demonstrated the buffoonery
This
before,
is
but
honestly, Adam, this is, of all the mysteries to me in the universe, how the Fed maintains its credibility is by far the largest one. I mean, why we hang on every word from Jerome Powell at the FOMC press conference and what they say in the minutes of the meeting is beyond me. Like, why do we think that they have any great insight or are going to get it right when they've never been able to get it right before?
well, I'm there with you, and let's earmark this because I have a question kind of related to this, and it's I think we can argue. I think I'm not sure how much credibility the Fed really has, but I think people are forced to listen to them, even if what they say doesn't really amount to much. What they do does, right? So you've got to still be guessing, as long as there's still a Federal Reserve pulling into those important levers. You have to pay attention to what they're doing, because it actually really does have more influence than almost anything else in the system, at least the way that it's currently constructed. But real quick, you talked about the pressure that the administration's likely placing on the Fed right now, and technically the Fed's supposed to be independent, but we know it gets a lot of pressure. As I've said many times on this channel, I think you have too, Stephany, inflation is a stone cold election killer. Right. So, sitting administrations, they want to do everything in their power to try to address it because they know they're going to lose while inflation's raging. And with the new CPI at 8.6, a new high in this cycle, I'm going to go back to a question I asked you right at the start here. Do you think that makes it, puts more pressure on the Fed to continue demand destruction? Right, because it's showing that it's not getting the system under control yet. Inflation's still going up, not down.
Well, I mean, I think it does feed into this idea.
Our interview with Stephany will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And last, if the challenging macro outlook that Stephany has detailed in this interview has you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Stephany has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with Stephany Pomboy.